Thank you for joining iMeet. When you hear the tone, you will be the 24th person to join the meeting.
If you can still hear me, the thing didn't load properly, so I'll be back to you in just a second.
This meeting is now being recorded.
Oh, shit. Better stop it. Do I have to dial in or am I in?
It sounds like you're in.
You can hear me?
I'm getting in right now.
It is?
Yeah.
Okay, you can cut all this off, right? Is that correct?
What?
You can cut all this, what we just did off, recording?
Yeah.
Hey everybody, good afternoon. Sorry about the little technical delay there. This is David Blake with the Tuesday Tech Talk, and we're going to quickly review the last couple of days, try to figure out what this market's doing while it's going sideways in this trading range. Generally, I talk for about 20-25 minutes, then we try to open it up to questions, and maybe we can go over some different sectors or stocks or any other questions you might have about what we're going to do. All right, first we're going to take a quick look at last week's market letter, and then we'll spend some time looking at the stock market has basically done nothing over the last 5 or 6 weeks. In fact, as we speak right now, the S&P is at 2272, and back on December 13th is at 2271. So very tight range, going nowhere. Although the Nasdaq has is a little bit better strength. But anyway. Unfortunately, because this market's just going sideways, there's not a heck of a lot to go over this week, but I have some new charts that you probably haven't looked at, but I'd like you to be familiar with. So when you see a market like what we currently have, you can look for clues of whether it's going to break out to the upside or the downside. Other times when you have mixed markets like this, sometimes the best action is just to sit on your hands, and that may be the best course of action here over the next week or so. But anyway, going back to last week, the CTI on Friday dropped down to a -7. This week on Friday, the CTI will drop down to a -13, and all 5 cycles will be bearish. Okay, the market posture, if you've been following these the webinars, we've been bearish since December 23rd when the Dow closed at 19,933. So it's still off about about 70 points lower. Our leveraged ETF, triple ETF portfolios, I think we're down right now about, I'll tell you exactly, we're off a little bit. We've been up a little bit, been down a little bit. With this rush today, let me see here, we'll tell you what we're at. Looks like we're off about 1.8%. Last year we were up 70% on that on the trading though, so not too worried about it yet. Okay, so basically the market's done nothing for about 4 or 5 week period. If you're on the sidelines, that's fine. Momentum's neutral currently at +1. Sentiment has backed off a little bit where it's also neutral at 0, but we've had a little bit of, so we've come off a little bit of the bullish enthusiasm that we had going into it. Now, if you read last week's market letter, you saw that the words mixed and jumbled were mentioned several times. The sectors were also mixed. We had gains in consumer staples, energy and technology and materials were offset by losses in financials and healthcare. I noticed today healthcare is the only sector that's not positive except for utilities today. But the big jump in banking insurance stocks stalled out last week. They're actually, some of the groups that pulled back last week are actually some of the leading groups today. So maybe this is just a little bit of an oversold bounce for traders. But we're going to look at the different indexes in a minute, especially the NASDAQ 100. They still look very strong. The Dow and Russell 2000 and S&P 500 are showing some signs of deterioration. Nothing much that's pointing to an imminent pullback or anything. But you almost have a story of 2 different markets. So we'll watch whether the NASDAQ and NASDAQ with the tech holdings are going to pull the rest of the market out of the doldrums, or whether the Dow and S&P 500 all will finally weigh down on the techs and pull that lower. Okay, here's the first chart we're going to look at, and this is something that's a little bit different. When we talk about the CTI and the different cycles, what you'll notice here with this line going up, these are bottoms that the market made that we look at. These are this is a weekly chart, and this is cycle B that goes out 18 weeks. This would be the cycle A, where we watch it how it goes, and you can see the harmonics of this thing, where they kind of bottom at the same time. Then you have the sine wave here for cycle C, where it goes like this. And you're right over in here, you're seeing where you're going to have the different cycles actually going out about another maybe 4 or 5 weeks, 6 weeks, where these are going to all start heading down as early as maybe next week. We'll have to see what happens, but you can see they move in harmonics, and this is where we're looking at where the things should pull down. Now, if we don't get a pullback here over the next, like, say, 2-3 weeks, what I have to reconsider, and with these cycles, this is not exact science, there's a possibility that back here before the election, that it's still in the range of where all 5 cycles would have bottomed, and this would have been the start of the new bull market. At first, we thought since it jumped up so far that this may have been kind of a blow off top. That still may be what's happening, but we'll know over the next 3 or 4 weeks. Now, this ends up being where the cycles all reset for the next 4-year bullish business cycle. We would be bullish, and we'll still stay bullish going out through into about May or June or so. But what's kind of funny is we do run some different portfolios, and despite the fact that we're going, that according to my forecast, I think we are going to pull back, none of the stocks are really getting sold. We're still long our holdings. Normally we're at the top of a market before everything bottoms out, like over in here. You're starting to come out of a lot of different positions over this time period, and you're pretty much into cash when you start to bottom here and move forward again. But we'll see over the next 3 or 4 weeks whether we're going to pull back here, recalculate the business of the CTI to start here, and it'll all be bullish going out probably for several months, or whether we'll finally get that pullback right over in here, and then we'll see if we'll kind of see if that's going to happen or not. But again, we're kind of in limbo. My suggestions are not to really be adding to positions over here. And in fact, if something gets downgraded, I would probably go to my cash and then see what's going to happen over the next 2 or 3 weeks. Okay, so anyway, this gives you a little bit more of an understanding of when we talk about the CTI, how we look at how the cycles and all go. But down here on the different technical indicators, you're starting to see some rollover on the MACD. RSI has worked off its overbought condition a little bit, and then here's stochastics. They're still overbought, but you do have a little bit of a crossing over here, which signals that maybe, but these are really very neutral to bullish, and I wouldn't be considering this negative divergence at this time yet. Okay, the next one we're going to look at, what I want to look at here are several breadth indicators. Some of these you're familiar with, but I am going to introduce a couple new ones. And what happens when you have a market that's going sideways, like what we have over here, where you're just wondering, okay, we're not going anywhere. It's been 1, 2, 3, 4, 5, 6, 7. This is the 7th week of just sideways. Some of the technical indicators will often give you a clue as to what's going on, whether you see positive divergence or negative divergence. It'll help you decide where you can forecast where the market's going to go. Now, this is the NYSE Advanced Decline line. Okay, so we're making new highs over here about 2 weeks ago when it topped out, but okay, we haven't done it yet. Now today, the breadth is pretty solid on the NYSE. You may get another breakout to a new high. If you do, that's going to be bullish for the market. If we get over here and have kind of like a little bit of a double top and start to pull back again, that would be a sign of some negative divergence. Or at this point, at this stage, I don't really see it's pretty neutral unless we break up this way or we break down to that way. So that's not really giving us much of a hint. Okay, here's the NASDAQ Advanced Decline. This is a little bit of also it's kind of neutral, but when you're making new highs, you'd like to see this breaking out to the upside up here, which means that you're getting broad participation as the market's making a new high. Again, today is the AD lines are pretty favoring the bulls again, so we'll probably get a move up to here. If we get up to here and we start pulling back again, that's going to show some negative divergence, and we want to keep an eye on that. So this is struggling to make a new high while the Nasdaq is making a new high. That's a little bit of a red flag. Okay, over here we have the NYSE new 52-week highs versus new 52-week lows. Not telling us a heck of a lot either. The new lows are staying pretty. They're staying here around the maybe 20 new lows a day. Nothing big. Up here we're generally around 80, which is okay. I'd rather see it up around 150 to 200 when the index is making a new high. So this is again kind of a neutral reading for that. If you go over to the Nasdaq, you're getting a little bit of negative divergence in the new lows. It's gone from around 15 or so. We're up here now around 40, 46 new lows a day. Nothing big yet. If it gets up over 60 or 70, then you might start getting this thing pulling back again. But we're still up around 100, 110 or so on the Nasdaq, making new highs, new lows. Not a lot of leadership and a little bit of negative divergence, but not enough that I'm would feel comfortable saying, okay, sell this top. Okay, this is something else. We want to look at a little bit of sentiment. And if you read the market letter on Fridays, we talk about the percent of bullish investment advisors getting above 55, which is right over here. That would be bearish. What this is it's a contrarian indicator, meaning that when the professional money managers and all newsletter writers get too bullish, it's kind of a sign of a top. The reason that is that if all the advisors and professionals are all already in the market, that's why they're bullish. They're fully invested. You don't have enough money to push stocks higher, so that generally will signal the top, and that's why they consider this a contrarian indicator. But what's important on this thing is last week, and this thing runs about a week behind. If you ever get to Investors Intelligence is the name of the website. Last week we hit 60.6%. Above 60 is a red flag. The last time we got this high was about mid-2014. We ended up having a bit of a pullback in July, and then we had about a 6% pullback in October. So I pulled up the weekly chart again over here. So right over here, we're getting to 60.6. The market did move higher for about the next 2 weeks. Then we pulled back about 3-4%, bounced back, and then we got back in here. We had about a 6% pullback from 17.2 down in here to 1,600. So that's where you'll see these things top out. Over here, I want to show you back in here with the bearish percentage, but we have right here. I'm sorry, I'm stumbling around here. This is the weekly bearish percent advisors, and you're all the way down to a 17.3%. Now that's the fewest bears since August 2015, which was right here. So that was a signal, obviously, when you get, if no one's bearish, everybody's bullish on the market, which was right here, that's usually a big red flag, and you want to take a lot of caution in that thing. So the market gets crushed over here, no one's bearish, catches them all by surprise. Now, part of that is when you talk about, the market climbs a wall of worry. Well, when no one's bearish, there's not much worry there. It's too complacent, and this is what happens. They kind of get caught off guard. So this is something you want to watch this thing. Like I said, it's been a long time since it's been this bearish. We'll have to see what happens in here. And this is even with the market going sideways. So even though it's not pushing the new highs, they're getting more and more bullish on this thing. And again, that will be a red flag. These charts you can also find on the Market Edge homepage under Markets at a Glance. So you get some really good information on that. And then actually another signal on this thing, when this gets too high, when everybody's overly bearish. You saw this back in February of last year, which was right over in here. Okay, this thing got up to 39.8%. Came down here, tested the 50-week moving average, and then we bounced back. So when everybody got that bearish, which was the highest it had been for a few years, the market immediately took off. We had a nice rally going into the springtime. So keep an eye on that as a contrarian indicator. And again, this actually, both of these are red flags that you want to be watching in here. Okay, there's something else you want to look at in here, and this is something we don't usually look at. This is a chart of the volatility index, the VIX, V-I-X. And what this is another, what they call sometimes is the fear index. And what it actually measures is how much premium is going to be in options. So when traders think that there's going to be a spike in up or down in the market, you'll get it moves like this when a thing jumps from 12 up to 62. This was back in August 15th when the thing rolled over and we had that big correction going in there, spiked all the way. So you can make if you're kind of a madman, you can make some big money, but these things have a downward presence to them. So you kind of want to. It's not something you buy and you hold on to for long-term trades, especially if you go into the ETFs. If you don't really want to buy options, you should look at the ETFs. In this case, we're over here around 1140. Today we're at, with today's little move, we're at 1135. Right over in here we're at 1124, which is the lowest we've been since back here again in July. Again, we just showed you the chart. That's where the market kind of rolled over and then it kind of stumbled again over back and forth in this area here. So people are too complacent on this market, and when that happens, usually bad things kind of happen. You see the MACD is going negative here. It means it could go a little bit lower, but you'll start seeing some divergence, negative divergence, some of these charts once in a while. But again, this thing is making multi-year lows. It's just a red flag, and it means that you need to have a little bit of caution. Now, when I told you about if you are kind of a madman, I want to get some advantage of some of these big moves like this. The UVXY is an ETF that tracks this thing. Now, there's always a downward bias to this. That's why you don't buy this and hold. You could have bought this thing at 12 or something the other week, then just did I think a 3-for-1 reverse split. So you're down here, very extremely low. But if this thing would all of a sudden have like a 5 or 6% correction, you could see this thing jump up here to 35 or 40. So you get a heck of a trade, but it's something you want to go into. You don't want to front run something that you think is going to happen over the next 2 weeks. Like with the CTI, if we think the market's going to could correct here over the next 2 weeks, you want to be aware of it, but be warned. This thing moves fast, and if you put like a market order to buy over here, you might end up getting that market order over here. And if you put a market in to sell over here, you might get in that market order might get sold down here, because these things spike up and down, and you've got to pay attention to them. They're not for the weak of heart, to say the least. But again, if it's something that you see the market, you're starting to get traders get a little bit nervous, you can always buy this thing and try to get a little bit of a trade on there. But again, that's not for everybody. I really don't recommend what's going on with that. Okay, I want to look at a couple of the different indexes. Again, I'm not going to go over all the sectors today because there's not a heck of a lot going on. They're going sideways along with the market. But I wanted to see if there's any kind of signals and different indicators that we can look at when the market's going all across like this. What's going to happen. This was updated this morning, 2269. We moved up a little bit higher. If the market can break through this 2281 on the upside, we're at 2274 right now, you do have a chance for this thing to possibly spike up to about 2320. That would be the next resistance on the pivot points. At this stage, I don't see any positive divergence going on. In other words, if it was positive divergence, while this thing was going sideways or slightly down, you might see the 14-day RSI starting to tick up over in here, or you might see the stochastic going, having a little cross like this, or the CCI starting to move up. So it's basically pretty neutral. So it's really not getting any signals here, so you're going to have to watch the resistance level. Break above 2281 would be bullish for the broader market. I will tell you this, I'm watching this 2255 area. We get to that and a break below, which would test the 50-day moving average. We get a break below that, I would be looking to lighten up and probably add some short positions on that stage. So, again, nothing really giving us any hints as what the market's going to do on the S&P 500. Here's another chart that I usually don't show, but I think it kind of supports the case that we may be having a little bit of trouble going forward. This is the American Stock Exchange. It's mainly composed of ETFs and derivatives. A lot of gold mining ETFs, gold, things like that are happening here. And when this thing's gapping up like this, it's very overbought. You've seen some pretty big moves in gold lately, which I think if the market does start to pull over, you could buy some of these gold things if they pull back a little bit. But here you have the 14-day above, RSI above 70, that's overbought. Stochastics are also overbought. CCI is overbought. MACD is telling you that you probably have some more upside, but again, you've broken through resistance, but you're close to this 2408 on the American Exchange. You might get a little bit higher action in this thing, but I would be, well, today we're up we're at 23.99, so you're almost to this 2400 right in here today. So you're getting close to what I would think of a top. If you break through that and get to the 2440, that would probably mean that you're getting a pretty good move in some of the gold mining stocks, and people are kind of hedging themselves to get a little bit more defensive. But keep an eye on that one. Okay, lastly, not lastly, but here's the Dow Jones Transportation Index. We had kind of a pullback in here, came down here. We kind of glanced at the 50-day moving average, and we're kind of working our way higher. Today we're up 120 points, 1.3% at 92.50. So we're back up here at this range right in here, not breaking out to the upside, but every component in the Dow Jones Transportation Index today is higher, I think, except Southwest Airlines earlier. So that's strong. If we can come up back here and do another test of this high and break through this 93.63 area, that's bullish for the broader market. Now over here you are getting some positive divergence. You have the CCI coming up pretty strong. You have the RSI. Remember we talked about once in a while, if you watch this, the 14-day RSI, if we're going to stay bullish, you want to see this stay above 40. Don't just look for the overbought and oversold areas. This, if you're in a bull market, this thing will pull back to around 40, and it'll usually stay above that, and then it starts going higher again. That means that the overall trend will remain bullish. And we stayed here with 48, 47, somewhere over here, and now we're working our way. So this is showing some positive divergence, which means that maybe we're going to make another run up here again. So again, a neutral to bullish chart, not really telling us a heck of a lot where this thing's going to resolve itself. Okay, the last chart I want to show you, well, next to the last one. This is making a new high today. This is the NASDAQ 100 index. Again, we're overbought. The RSI is at 66 today. It's probably pushing a little bit higher than that. So you're seeing, confirmation of this trend higher. The NASDAQ 100 is comprised of mostly big-name tech stocks. This is your Google, your Facebook, your Yahoo, this type of stock. And this shows that that's where the leadership is in the broader market. So if you're, if you absolutely have to go into something right now, that's what's pulling the rest of the market up. And again, like we talked earlier, either the Dow and the S&P and the Russell 2000 begin to pull this thing down, or the strength in these in these big caps will help resolve the Dow and the S&P to the upside. I remember last fall, I should have had a longer chart in here. In November and December, when we were having the webinars, we kept saying, okay, well, look, we're getting the internal breadth is getting worse, but you're making new highs because of the FANG stocks. But the number of stocks that were within 1% of making a new high at that time was about 6 or 7%. Okay, now we're making new highs, and we're up around 19%. Over in here, you had about 24, 25% of the stocks at this stage were within 1% of making a new high. So that's gone from 25% down to 19. That's a little bit of negative divergence. We don't have that anywhere in the chart, but I'm just telling you that's a little bit of a warning over here. And again, you had the MACD starting to almost give a sell signal on that. So kind of a narrow rally, but we've got the big cap names and the weight adjusted indexes. We'll have to see if this is kind of blowing itself off, or it's going to have enough strength to pull the rest of the market with it. Okay, the final one we're going to look at, if you have any questions, you can start putting them in now. This is the Russell 2000, the small caps. It kind of led the way over here. Trump's policies were supposed to be good for the small caps, and the companies doing business in America, we outperformed. And then we've kind of gone sideways. I don't know whether this is just investors and traders waiting to see how these policies are going to work out or what, but we've came down here, we're bouncing around the 50-day moving average. This is the first index to really kind of test this thing, and I would say if we see this break down below, okay, we're at 1361 right now, which is getting us back up to this level where we were about 4 or 5 days ago. Just keep an eye on this to the downside. If you see it below, say 1347, 1345, a red flag, and with the indicators start, still negative on this, negative to neutral. And you see the RSI is 48 down here. So if that drops down into around 36 or something, that would be another red flag. A little bit oversold here, so this may just be a little bit of a bounce. We'll have to wait and see what happens in the next day or two. But again, this is this led us on the way up. If it breaks below the 50-day moving average over here, that would be the red flag that could be a little bit too much weight for the rest of the market to stay up here in the nosebleed seats. So keep an eye on those. So anyway, just to wrap it up, I hate to come, have you tell you that everything's mixed and it's still up in the air as far as where we're going to resolve this thing. You have a lot of conflicting data on the internal breadth as well as the different indicators. If we can get a push, on the S&P to a new record high, we probably get a bounce to maybe that 20,000 on the Dow. Again, it's whether or not that would be like the last of the blow off top. We'll have to see. At this stage, I'm a little bit confused because of the conflicting signals. I'm not buying new stuff right in here, and I'm waiting for to be taken out by the second opinion, especially on the weekly model. I use that on exits a little bit more than I do the daily second opinion. The reason being, over here you'd probably get taken out, but on a weekly you're still in, and it'll give you a chance to pull back a little bit. But if I start to get pulled out of stuff, fine. But at this stage, I'm still long what I was long over in here, and until I'm taken out, well, I'll stay the course. But there's enough conflicting things that I am a little bit cautious, and I want to see probably over the next 2 or 3 weeks whether or not this thing's going to finally have a little bit of a crack in it. With that, I'll open it up to questions, and we'll be back next week again. I don't see anything coming in yet, but I'll give it a second here. And also, if we don't get to any of your questions today, you can always email me at the doc@marketedge.com, or send your questions to support@marketedge.com, and we'll get you. I'll try to get back to you one-on-one. Okay, I don't see any questions, so I'll go ahead and wrap it up. I appreciate you joining me, and just different charts that we looked at today. You can find a lot of them on Market at a Glance. Keep an eye on these things because they usually should give us a little bit more of a clue. Right now, we're pretty neutral, but I'll say so long. Have a good week trading, and I'll talk to you next week.